You need to understand that we may be on the cusp of more bank failures. In fact, Billionaire Barry, at least that's what we call him on this channel, is talking about one bank failure a week because of real estate, more specifically commercial real estate. Billionaire Barry from Starwood fame is not having a good year. He had to shut down his mortgage business. He had to stop paying his dividends. Then he sold all the single family homes to raise cash. And Barry is in trouble. But what does the banking crisis mean for you? First, we're going to talk about what it is and then how we can take advantage of it. How you doing, Jonathan? A lot of
I'm
stuff going
good.
on.
Yeah, lots of stuff going on. Not all of it fun,
Not
but
all of it fun, yeah. Well, but part of the cycle, yeah, you got to, some pain is to be had. And Billionaire Barry is undoubtedly feeling lots of pain. I think you just, you stumbled across something he's taking a big haircut on here.
well, yeah, no, I didn't dig into it, but something flashed up this morning while I was, scrolling on LinkedIn about how Barry is Starwood anyway is losing
Right.
an office building, taking a substantial haircut on one of their office properties. So, just sort of more of what we're seeing out there. But Starwood
Yeah.
is definitely taking a beating on a lot of the stuff. So.
Yeah, Billionaire Barry did not listen at the Jackson Hole meeting when Jerome Powell said, "I'm coming for you guys." His debt clearly was not locked or fixed, and thus he's scrambling. But let's talk about the banking crisis. I think it's kind of insane to think about one bank failure a week. But I did see a Fed report that said something like 232 banks, might have been 242, are on the quote unquote watch list.
Yeah.
Most of them are small, sub 10 billion, like 95% or sub 10 billion. But the reason they're in trouble is very much Silicon Valley Bank. Silicon Valley Bank was a monster at 240 billion. They got with 10-year treasuries, right? The treasury debt that reset. But there's a lot of small banks that have commercial real estate.
Yeah.
And if they're forced to recognize a loss, it can go and go quickly. Is that fair to say?
Well, yeah, I mean, if they're overweighted towards commercial properties that, have lost all this value and they haven't marked them to market and they're kind of pretending that they still are solvent, right? Uh, if once they're forced to mark those properties to market, it's going to be pretty disastrous. I mean, I don't know enough banking about banking to say whether, marking those loans down really affects like the bank on an operating basis, but in terms of what like they're required to have in terms of like their balance
Yep.
sheet and reserves and things like that, it really does affect it. So you'll see the bank regulators step in and
Hmm.
shut them down, force them to consolidate with other banks, that sort of thing. Um,
Exactly.
so this is, and listen, in normal circumstances, I mean, we have like a couple hundred banks fail every year in the United States in good times, right? This is not banks failing is a thing that happens all the time, but I think we're going to be in for more of it
Yeah.
because banks got really, high on their own supply, I guess. Like that, but and listen to the banks, to their credit, I guess, nobody really foresaw that the best asset class in the world being office was going to
Mm,
suddenly tank the way it has, right?
yeah.
And like that's, those were really like that was for banks lending on office, that was like the blue chip
Yeah.
stuff, right? It was like buying, IBM back in the day, right? And
Mhm.
so can't blame them for that, but that doesn't mean that this isn't going to be a huge problem
Yeah.
for them. Of course, multifamily being the other thing that was supposed to be so safe,
Mhm.
um, they leaned
You know
into
what?
that as well.
I don't know if you've seen these numbers. You may have. You're watching this, but the Resi Club, Lance Lambert,
Yeah.
has highlighted multifamily. I have the numbers right here. From Q2 2007 to Q3 2009, multifamily went down
Oh yeah.
34.3%.
Yeah.
34. Today, as of at the end of last quarter, multifamily is down 26.9%. So what I'm telling folks, and I'd be curious if you'll take the over or the under, but I think this crisis will dwarf last crisis at 34. We're going higher. We're already at 27. I think we're going higher than 34. What do you think?
Well, so the issue with multifamily in the great financial crisis and now is actually different. And
I agree.
so the issue with them was actually that a lot of properties on an operating basis were sucking wind because unemployment went so high. So you had a lot of buildings that just were not, they were actually, losing money on an operating basis and couldn't pay their debt.
Mhm.
And you kind of combine that with the fact that, of course, like at the top of the cycle, everyone always gets over leveraged because they're trying to squeeze yield out of these deals. So back in the great financial crisis, they were getting permanent debt, and then they were putting a slug of mezz behind it, and they were like levered up to like 85, 90% in some cases. And
Wow.
as soon as their occupancy dropped, or actually their economic occupancy, because they were full of tenants, but they weren't
Just not
paying,
paying. Yeah.
right?
Yep.
As soon as their collections started dropping, they just couldn't service this huge debt. We're in a little bit of a different situation now where, except for those markets that are oversupplied, and everybody is saying that the absorption is kind of working in the right direction, so that will correct itself eventually. There are a lot of properties that are in trouble because of the debt and not because
Oh, it's
they're
absolutely the debt. It's
yeah.
this
So
time is all about the debt.
it's all
Yes.
about the debt, which means that I'm not I'm honestly not sure if values will fall that much more unless, and this is the caveat, unless you start seeing the market getting flooded with property, right? I think that's
Yeah, I'll take the other side of that because this is going to be slow. It's going to be a slow burn. But if we keep seeing rates at 7% for resi, that means you're at 8, 8.5 for commercial, and there's just so much pain to unlock, right? We have a lot of extended pretend. We talk about this, the third inning of a 9 inning game. Uh, and again, I think you and I highlighted a couple of years ago, there were so many properties, Jonathan, that retraded like 2 or 3 times.
yeah,
This
yeah.
greater fool. There's got to be a price to pay. And unlike office, which was kind of set it, forget it, this multifamily stuff traded like a monopoly board. And you've got to unwind all of that. In my opinion, it's going to be significantly worse than 34%.
Yeah, I mean, I'm not. If it happens, it won't be surprised. But I don't know. My gut just says it's not going to get that.
Okay. I like it. I
But
like
but I think
disagreement. It's awesome.
but I think that what you could see though is sort of depressed values for a longer period of time, right?
All
So
right. All right. Let's talk about transactions because I think where we may be differing is in order for me to be right, we have to have price discovery, which means we have transactions.
yeah,
If
I
we
mean,
just keep limping along with no transactions and no discovery, maybe it doesn't happen. I don't know.
because listen, what's happening right now is there's a very small number of properties coming to market, and
Correct.
what's happening is either they're not getting sold at all, right? Because they're not getting the price that they want, or they're getting overbid actually. And the
Hmm.
difference is they're like the few high quality properties that are coming to market that are not distressed sales, that are good locations, the operations are high occupancy, good tenants, all that kind of stuff. You're actually seeing a lot of bidders coming to those markets because there's so little to buy. And so obviously this is on the higher end of things, right? Which is
Sure.
kind of what gets reported. On the lower end, you probably have a different phenomenon with not as many people coming to bid on those properties. But so that's prevented prices from dropping as much, right? So a lot of the kind of price decline is really sort of implied price decline
Mm.
the you know based on the interest rate, changes and things like that. I think that like the properties are going to be dribbled out onto the market intentionally to try to
Hmm.
prevent the price decline. It's going to be a managed
Right.
disaster more so than the great financial crisis, and everybody just foreclosed and dumped the properties on the market. So I think that
Yeah.
may slow the price declines. The other thing too, we had so much rent growth in the last few years, which is something that you didn't have as much to. But see, before the great financial crisis, properties were already like, occupancies at multifamily properties were around 90%.
Yeah.
The great,
At the start, they were pretty low. Yeah.
yeah, right. So, because during the run, everybody's buying houses, right?
Yeah,
So
I've told you this story. I'll tell it again here. I remember routinely declining tenants that ended up buying a home. Think
yeah,
about that. A landlord says no for credit or income or whatever, and then they buy a home. It
yeah.
was wild. It was
I mean,
wild.
I remember right around that time, sort of before I got married and before we bought our place, I was renting, and I remember going looking for an apartment. I don't know, this was like 2003, I think. And because everybody was buying houses, like they were doing concessions in New York
Yeah.
City, right? And
And that
getting
was again,
in 1 or
you're
2 or 3
absolutely right.
months, yeah, get like rent, free rent because they were scrambling for tenants, and it was because everybody was buying houses, right? Everybody's buying condos. That's not been the same case this time around, right? Occupancies are around 95% across the board, right? There are some markets where it's fallen because of a huge amount of new supply coming in, but the absorption like worm has actually turned just recently, where now you're starting to have positive absorption again. So it's going to take a long time to work through that inventory, but the trend is in the right direction, right? For that. So I think that there's less operational distress than there was before and more debt related distress.
Yep.
So I think
Agreed.
I think that will keep the decline from being as great, but I think it'll make the depression last longer, right? Because I think
Correct.
it's going to take a long time for, um, for rent growth to get going and start getting NOI growth, which is going to then raise values at the same cap rates, right? So right now, I think cap rates they seem to have stabilized, but right now we're in a position where like nobody's getting any NOI growth. There's also been huge expense growth. There's like stuff like that going on. It's just going to take a
Yeah.
while to like work itself out. So I think we could see a market probably where you're not going to get really any appreciation for a while,
For
right? There's
years.
not
Yeah.
any cap rate compression for a while, as because the NOI machine has got to get cranked up again, and that's going to take a couple of years. But I'm not
Agreed.
sure we're going to see massive, like more a great, a whole lot of price declines, unless, as I said, we start seeing a lot of foreclosures and then a lot of stuff coming to market. Like that will lead to it. But I think now we're 25% off
Yeah.
the
Yep.
peak. Like I think we're kind
Okay. I
of
like it. Well,
that's
the
my
other thing we need to understand about a banking crisis, and I think we talked about this just touch in the first video, is banks are going to get a lot more difficult to work with, to get loans, to get a yes answer. Loan to values are going to go down. Credit quality is going to go up. Loan products are going to disappear. And there'll just be less origination. I mean, that's another outcome of this crisis, I think.
Yeah, but and then that leads to kind of like an interesting question, because if banks stop lending on multifamily, or they just make it really tough, and then you've got all these maturities happening. Well, where's the takeout? Like who can get, is it all going to be cash buyers? And if that happens, then I could,
Price. Yeah.
then price will definitely start
Well,
declining.
that again, it is mind-boggling to me, Jonathan, that we are repeating what happened in residential. And let me, so again, what happened in residential last time? Adjustable rate mortgages, short-term adjustable rate mortgages, um, bad assumptions, right? Only goes up. Non-operators, people were flipping multiple properties or flipping contracts, and then the pain came. Everybody lost. And then the banks stopped lending, right? They did 4 loans. I I I think what you just stumbled on is the next domino. It
Mm.
might be 6, might be 9, might be 12 months out, but banks are basically going to turn off for a little while. And then to your point, that's what really caused the cascade of prices in residential to fall, is there
No,
was no lending.
no lending.
That's what
Yeah.
happened, right? So again, my market was, my peak was 300, started coming down, let's call it 200 just for round numbers. Banks turn off and stuff starts going sub 100 because
Mm.
I, who was an active buyer, I had to pay 12% to some hard money lender.
Right. Yeah. I mean, I was actually going to suggest that, like, if the banks stop lending, these private lenders will step in, but those interest
Oh,
rates are going to be high.
3
right?
points,
Yeah.
60% of purchase or appraisal, whatever's less, short term, 2, 3 years. I mean, that's where prices will come down. Values will, it'll because you just can't, you got to pay a lot less when you pay 12% for your capital than six.
Oh yeah, absolutely. Yeah. So, or two or three, right? I
Right.
mean,
Exactly. Exactly. Yeah.
so
So this is a problem.
yeah, it is a problem. Um, so again, like, in the last segment, I talked about getting cash ready. I mean, cash buyers, you know, you may be able to, if you can put together a few $100,000 in cash with you or you and a couple partners, you may be able to
Yeah.
pick up some smaller multis, just buy them for cash, and then just hold
That
them,
is coming. Yes.
just hold them, get the operations in order, and then when the lending environment loosens up, you're going to have a more value. You can probably finance out all your capital,
Oh,
right?
absolutely. Without question, you'll get all the capital back. And I don't know if you saw this, but Grant Cardone, this is from memory, so I might be off, but he just closed, I think it was on like a 1,500 units somewhere in Florida. He paid cash.
Really? Wow.
Cash. We called his shot, right? I talked about it about 9 months ago. He was going to start buying stuff for cash so he didn't have to loan.
Yeah.
And he just did it. He just bought a building cash. I mean, like, I don't know what it was, 500 million or something. It's crazy. Yeah. So this is coming. Yeah. Again, folks, we talk about the big stuff because it moves the needle, but this is coming to 5 to 40 unit buildings. This is where I'm excited. This is where I'll buy the biggest thing ever. And you're absolutely right. There'll be some commercial stuff that comes on that's just not bankable, not lendable.
Yeah.
Because this is the dominoes that I see coming. And I'm going to play this out. You tell me where I'm off. Right now, and again, I'm talking small 5s to 40s.
Yeah.
There are some operators that have, they're either already in extended pretend or the maturity date is right around the corner. And they know they can't, they know they can't afford it, right? The cap rate has changed, the LTV has changed. They can't get out. And they don't have enough cash to do a cash in refi.
Mm.
So what is already happening, in my opinion, is you're already seeing some stuff listed, but it's listed at wish pricing. And this
Yes.
happened last time,
Yeah.
right?
Absolutely.
Because it's not in foreclosure yet. The
Yeah.
sellers put it out at a number where they're like, okay, I got out. I'm safe. But that doesn't mean that's the actual value.
Yeah.
It's probably significantly less than that.
Absolutely.
And then at some point, the bank will force or the bank will take it back and then you'll see a big haircut. And here's an example. This is what I did last time. There was a building. I still own it today. It was listed for 1.44 million. Why? Because that's what that's what the owner bought it for.
Right.
And they were trying to get out for what they bought it for. Oh, by the way, it was listed for over a year at
Yeah.
1.44, no price drop, nothing. And the building just kept going downhill because he wasn't putting any capital back into it because he knew he was going to lose it. Ultimately, the building got foreclosed. We worked with the lender and we picked it up for 700 grand.
Wow. That's amazing. That's great. And then, yeah, you're going to see stuff like that. That's going to happen.
Absolutely.
Yeah. I mean, listen,
Yeah.
the first multifamily property I ever got in contract on, we ultimately weren't able to close it because of lenders again, right? But that property, I remember it was in Louisiana. It came on the market at $4 million, right? And it was not a distressed deal. They had paid off their loan. I mean, they had no basis left in it, right? This was a smart seller who was looking to free up cash to buy in the
Right.
downturn, right? So, but he went out with a wish list price, like 2008 pricing, and the thing just sat there for a year, right?
Mm-hmm.
And we looked at it once and we're like, it's not worth $4 million. We basically we came back like 6 months later and offered him 3 and he took it because he knew that he was a smart guy. He knew that's what the property was worth. He bought it for 1. He was still making $2 million, right? He wasn't going to be greedy about holding out for that other million because he was thinking about, well, now I'm going to go buy a Class A property
Yeah.
for $2 million.
He's going to redeploy the capital, right? Exactly. Yeah.
It's like a bigger and better and newer property, right? So, there's going to, and even for non-distressed stuff, you're going to see
Yeah.
that. I would say that like, if you see stuff that's sitting on the market like that, don't be put off by the asking price. Just make an offer. And here's one other thing. I don't know, Michael, if you ever noticed this, and maybe it's different in residential, but so with a commercial property, when the market is hot, nothing will ever have a price attached to it in the listing, right?
Yeah. Yeah.
Because the brokers don't want to accidentally put a cap on the
Right.
price that people are willing to pay. So it'll all be unpriced, which is essentially like, you go figure out what you're willing to pay.
Yeah.
Right?
You tell me.
You tell me, right? And everybody is going to start bidding on it. And usually, it's in a sophisticated market, most of the bidders will come out around the same value because they're getting this, it's the same debt. I mean, they kind of come out around the same. What happens when it's a buyer's market, though? That commercial property starts having a price in the listing, and they're doing the opposite thing. They're trying to anchor you to a higher price, right? They know you're not going to offer I mean, they're hoping maybe somebody does, but they know chances are you're not going to offer the asking price. You're going to go underwrite it. And so let's say it's a $4 million deal, or they're listing it for 4. They know you're going to underwrite it at 3, but they're hoping that you're going to be like, you're going to kind of start psyching yourself out and thinking like you need to pay 4. So then you'll offer, 3.5, right? That's how the game is. So whenever you see a property with a listed price, then you know that they believe it's worth less. And if you see a listed price and you see it's been sitting on the market, then you got a seller who is like increasingly sweating. And then what I'm starting to see with some hotels I've been tracking that have been on the market for a long time, now you're seeing price cuts. And it's like, and that's
Hello. Yep.
that's the signal that like, okay, so that in the seller's mind, what they're really trying to get has just gone down even further. So like, make an offer of what you think it's worth.
Yeah.
It's been on the market for a long time.
Do the work, folks. Do the work. Do your numbers. Write
That's a seller
disrespectful
who,
offers.
yeah, that's a seller who might be ready to throw in the towel for whatever they can get.
Absolutely. Again, 1.44, picked it up for
Yeah.
$700,000 in the last cycle. Jonathan, you're amazing. Thank you for doing what you're doing. Thank you for dropping all these gold nuggets. Where can people find you?
Yeah, well, let's just come follow me on LinkedIn, and you can link with me and let's have a conversation. And there's always apartmentinvestorsclub.com where you can get on my mailing list as well. So I hope to see you in one of those places.
Awesome. Thank you, buddy.